Hello YouTube, my name is Jake. In this video, I will show you how to analyze a cash flow statement by using the ratio analysis method using Amazon as an example. If you haven't watched the part 1 or 2 where I show you how to analyze the income statement and the balance sheet, I highly recommend you to watch it after this video because you need to understand how to analyze all 3 different financial statements to fully understand the financial position of the company. What is cash flow statement? The cash flow statement simply summarizes all the cash in and outflows of the company. You can think of cash flow like blood in the human body because a company with healthy cash flow can sustain and grow its business just like how healthy blood circulation will promote a healthy body. Since the cash flow statement measures how well a company is operating, you can see how the company manages its overall cash by looking at the 3 main components in the cash flow statement: cash from operating activities, cash from investing activities, and cash from financing activities. Cash from operating activities shows all the cash in and outflow from the business operations. A healthy company should be generating positive net cash flow from its business operating activities, and it also should be growing consistently. However, if a company fails to generate positive net cash flow from the business operations, this may put the company in a position to take in more debt to cover its expenses, which will not sustain for long, and this is a big risk for investors. Cash from investing activities shows all the buying and selling assets. Growth companies generally show negative numbers in the investing activities, which means that the company is heavily investing in the long-term assets that could potentially bring in more profits in the future. Cash from financing activities shows all the cash in and outflows of issuing or paying off the finance-related activities such as stock, debt, and dividend payouts. This section can be tricky to understand because it all depends on the situation of the company it is in. If a company issues bonds, equity, or stock to investors or borrow money from the bank, this may result in positive net cash flow. On the other hand, as the company pays off its debt or repurchases stock to increase the value of the stocks, or issues more dividend payouts to the investors, net cash from financing activities may show as negative. This section really depends on the current financial position of the company is in, because the company that focuses on growth will most likely want to raise more money to expand quicker, whereas a company that's already well established would want to pay off its debt and issue dividends to shareholders to keep them happy. Now that you understand what a cash flow statement is, let's cover the ratio equations to evaluate the cash flow statement. Free cash flow to revenue ratio is equal to free cash flow divided by revenue. This ratio shows how much cash will be available for the shareholders when deducting the capital expenditures based on the revenue. Free cash flow is very important in valuing the company because it represents the leftover cash that could be utilized to pay dividends to shareholders, repurchase shares to reduce the outstanding stocks to increase the earning per share, or invest in other areas such as acquiring other companies to enhance growth. Investing cash flow to operating cash flow ratio is equal to net cash flow from investing activities divided by net cash flow from operating activities. This ratio shows how much cash is spent on maintaining and investing in the company's growth. A company that focuses on growth will most likely increase earnings in the future by investing in new technologies or other areas that could bring in more profits. Operating cash flow ratio is equal to net cash flow from operating activities divided by current liabilities. This ratio measures the liquidity of the company by showing how much cash from business operation can cover the short-term debt. Dividend payout ratio is equal to dividend per share divided by earning per share. This ratio shows how much cash is available to shareholders for the dividend payout. lower the ratio, the company has less cash to pay out to shareholders. As an investor, you should focus on the company that can either give some of its profits back to the shareholders or invest all the profits right back into the business to grow the company, which will increase the stock price in the future. Before calculating the ratios, always ensure that the free cash flow and net cash from operating activities are consistently growing. Net cash from investing activities should show healthy signs of investing activities that promotes growth, and net cash from financing activities should be showing either signs of raising money or paying off the debt. As you can see, Amazon is growing its net cash from operating 35% on average. This is very impressive number considering that Amazon is about $1.62 trillion market cap during this recording, and it is still able to grow really fast. Net cash used for investing activities shows 74% on average. This is where you can see that Amazon is heavily focusing on growth since it uses most of its cash into investing activities. In my opinion, this is a very good sign because as an investor, I want to see tech companies like Amazon to focus on growth by investing in new technologies through R&D or purchase other companies to acquire new technology to innovate and enhance growth to capture other profitable markets. Net cash used for financing activities overall trends shows negative figures, and this may indicate that Amazon is paying off its debt aggressively at about 190%. This is very good sign because Amazon is not just using most of its cash on investing activities, but it also focuses heavily on paying off its debt at the same time. Lastly, free cash flow is growing at about 53% on average. This is a very great sign for investors because, as I mentioned earlier, free cash flow represents the leftover cash that could be utilized either pay higher dividends to shareholders, repurchase shares to reduce the outstanding stocks to increase higher EPS, or invest in other areas such as acquiring other companies to enhance growth. Therefore, it is good that Amazon continues to increase free cash flow. Now let's analyze Amazon's cash flow statement by using the ratio equations that we just covered. Free cash to revenue ratio shows 7% on average, meaning that Amazon has 7% free cash flow available to shareholders based on the revenue. Generally, a company that has free cash to revenue ratio higher than 5% is considered to be a high quality company. Investing cash flow to operating cash flow ratio for Amazon shows 79% on average, similar to net cash used for investing activity average number. By looking at this ratio, you can also see that Amazon focuses on growth strongly by putting most of its cash into investing activities. Amazon has been consistently venturing out to many different businesses such as AWS Cloud, streaming, Prime Video, autonomous vehicle, electric cars, logistics, cashless stores, robotics, and AI. In order for a company like Amazon to continuously enhance growth is to strategically utilize its cash to invest in new technologies that could potentially disrupt and outcompete its competitors by bringing new profit segments through other markets. I think this is good for the long-term investors since the stock price movement or the value of the company is highly based on the long-term outlook of the company. Operating cash flow ratio for Amazon shows 40% on average, meaning that the company can cover the short-term liabilities about 0.4 times over from cash flow from operation. Ideally, this ratio should be above 1.0, meaning that the company has reached a break-even point to cover the short-term liabilities with the total operating cash flow. However, a company like Amazon that focuses on growth can use the cash in the investing activities to enhance growth for much bigger profits in the future. In the previous video, part 2 balance sheet ratio, We saw that Amazon's current ratio was 1.07. The current ratio also measures the liquidity of the company, but instead of using the operating cash flow, the current ratio uses the short-term asset to measure the liquidity of a company. The current ratio of 1.07 explains that Amazon can cover about 1.07 times of its short-term liabilities, meaning that Amazon is already above the break-even point. Lastly, dividend payout ratio for Amazon cannot be calculated since Amazon does not pay out dividends. Instead, it invests all of its leftover cash right back into the business. After analyzing the income statement in part 1, balance sheet in the part 2, and cash flow statement of Amazon, does Amazon stock look attractive? Well, in order to answer this question, you must be able to answer a few questions on your own to see if it meets your expectations or not. I believe that in order to be a successful investor, you must understand the core underlying businesses that the company is doing by reading the 10K form or the annual report that all public companies are required to file by the US Securities and Exchange Commissions. This may sound very obvious, but many investors never even bother to read the 10K form before purchasing the stock because they want the quick, easy, fast, short-term gains by focusing on the new hot trendy stock recommendations that they hear either on the news, internet, friends, or family. By relying on other people to make a decision for you is putting severe risk on your portfolio because the information that you obtain from someone else could be overly exaggerated, misleading, or incorrect. By reading the 10K form reduces this type of risk because you can understand the company's business, risk factors, legal issues, and financials to make a decision if owning the stock is right for you or not. In my opinion, when you consider purchasing a stock of any company, you are becoming a partner with the company to do business with them by giving them the capital that they need in exchange for the share of the company. As a business partner, would you want to partner with a company that's not profitable or on the verge of bankruptcy? If you don't understand the company's financial position, you will most likely make poor investment decisions, and this is why you must know how to read and analyze the financial statements to think rationally and make smarter investment decisions. When you are very confident in understanding the core business and the financials of the company that you're trying to invest better have the best products or services in the market. Because as an investor, I only want to partner with the best business that offers the best quality products or services in the industry to outcompete the competitors to control the overall market. Lastly, does the stock that you want to buy match with the current industrial or political trend? Our current society is focused on the fourth industrial revolution or Industry 4.0, which promotes automation by using the most cutting-edge modern smart technologies such as artificial intelligence, Internet of Things, battery, renewable energy, big data and analytics, 3D printing, AR, VR, cloud, cybersecurity, crypto, 5G, and many more. Companies that can develop these type of technology trends fastest will outcompete their competitors by taking control of the overall market, and it will have at least 10x gain potentials until the next disruption arrives. These are my personal ways to identify and analyze high potential stocks. However, you must develop your own principles on how to find the best stocks to own by coming up with your own criteria and strategy that makes you feel comfortable. I hope that this video was helpful in understanding how to analyze a cash flow statement as well as developing the right mindset on investing. If you like this kind of video, please give it a like and consider subscribing. Thank you for watching.